If you want to understand how a nation can drown in $37 trillion of debt and still move as if the weight on its ankles has somehow gotten lighter, you have to look at the mechanisms that aren't announced on television. Every empire creates tools to manage the illusion of solvency. But some analysts argue that the United States may be experimenting with something far more complex, an evolving blend of crypto liquidity, gold repositioning, and debt engineering that operates beneath the visible surface of the financial system. Here's what nobody tells you. When an economic system becomes too large to fail, it rarely collapses outright. It morphs. It adapts. It hides its corrections inside everyday transactions so quietly that the public never realizes they just paid part of the bill. And here's why this matters. If these mechanisms are real, then the U.S. may be sculpting a new kind of monetary airbag, one that distributes the consequences across markets rather than taxpayers alone. The story begins long before Bitcoin existed. In 1971, when the U.S. suspended dollar convertibility into gold, a new kind of financial gravity took hold. Without metal as an anchor, debt could expand at unprecedented speed. By the late 1980s, total U.S. public debt crossed $2 trillion. By 2008, during the financial crisis, it had jumped beyond $10 trillion. And by 2023, it surpassed $33 trillion. Each escalation had consequences: higher interest burdens, rising dependency on foreign bondholders, and an expanding requirement for global trust in the dollar system. But look back at 2008 closely. That's when the origin point of the current mechanism emerges. As traditional financial trust cracked, two strange things happened. Gold surged from roughly $800 to over $1,800 within 3 years, and the first successful cryptocurrency, Bitcoin, quietly appeared on a tiny cryptography mailing list. Most people saw these as unrelated events. But here's the mechanism. One asset represented centuries-old hard value, the other represented digital scarcity. Together, they formed a new spectrum of alternatives to sovereign debt. This is where the pattern begins. After 2008, the United States didn't just expand its debt, it also expanded the tools it used to manage perception. Analysts suggest that the Federal Reserve learned an important lesson. You don't need to erase debt if you can dilute how heavy it feels. If enough liquidity enters the system, through stimulus, through asset inflation, through digital market expansion, then the denominator grows faster than the liabilities. In simpler terms, if the economy appears to get bigger, the debt appears smaller relative to the system supporting it. And while the public debates deficits on television, institutional players quietly adjust portfolios, shifting between government bonds, equities, gold, and in recent years, crypto assets. Some economists argue that a subtle monetization of risk has been occurring where digital assets absorb speculative pressure that once would have strained traditional markets. If that scenario is true, then every dollar flowing into crypto indirectly relieves pressure from the dollar-based system. But let me show you exactly how this plays into the idea of erasing debt without anyone noticing. Historically, when nations faced crushing liabilities, they used one of three strategies: devalue the currency, generate growth faster than obligations, or restructure the debt quietly. In 1920s Britain, devaluation became the method. In post-war America, growth was the weapon. In 1990s Japan, attempts at restructuring dragged on for decades. But modern conditions add something new: a global digital asset market that didn't exist in any previous era. And here's why this matters. When value migrates into alternative markets, governments can expand their balance sheets while deflecting inflationary pressure into assets outside the traditional banking system. Analysts propose that this creates a kind of release valve. Not a default, a displacement. Imagine the public debt as a balloon. Traditionally, if you inflate it too much, it bursts. But if thousands of new balloons appear, cryptocurrencies, tokenized assets, digital gold proxies, the pressure spreads. The original balloon still grows, but the strain is absorbed across multiple containers. Some economists argue that this creates a shadow stabilizer for modern debt cycles. If this pattern applies, then crypto doesn't weaken the dollar system. It cushions it. It catches excess liquidity, speculative demand, and inflationary spillover that might otherwise destabilize bonds or accelerate consumer prices. At first, it looked like a miracle. New markets absorbed trillions in global liquidity. Gold broke records. Crypto hit valuations previously unimaginable. But then the bill arrived. Every new escape valve creates new vulnerabilities. When Bitcoin crashed 80% in 2018, some institutions absorbed losses they had attempted to mask. When crypto collapsed again in 2022, with exchanges imploding and stablecoins breaking, regulators realized that digital markets were now systemically significant. Everyone thought they were safe. They weren't. The danger wasn't what people saw, the price crashes, the headlines. It was what they ignored: the interconnectedness between digital liquidity and traditional debt markets. Now, focus on the U.S. again. Analysts argue that policymakers noticed something during these cycles. Even when crypto crashed, interest in digital assets returned faster than expected. Gold demand, too, surged during periods of volatility. This hinted at a powerful dynamic. The public was willing to store value outside the traditional system, which meant new markets could continue absorbing liquidity as debt expanded. And here's what nobody tells you. If you can channel enough global wealth into alternative stores of value, you can dilute the visibility of your own liabilities. Not erase them mathematically. Erase them perceptually. History gives us the first case study: the Roman Empire's manipulation of coinage. When silver shortages threatened fiscal stability around 200 AD, Romans diluted the metal content of their denarius. Citizens accepted the new coins because the system around them remained intact. But the real effect was hidden inflation, an invisible tax that maintained imperial spending without explicit approval. Fast forward to the 1970s United States. After the dollar's final break from gold, inflation surged, wages lagged, and debt devaluation became a subtle tool for national balance sheets. People didn't see it as debt relief. They saw it as rising prices. But the mechanism was the same: shift the burden subtly, gradually, invisibly. Japan, the 1990s. After the asset bubble burst, Japanese authorities used creative interventions: zero interest rates, fiscal stimulus, and quiet bond purchases to stabilize a system under massive strain. This didn't erase debt. It blurred the consequences. But unlike Rome or 1970s America, Japan didn't have digital asset markets to serve as external pressure valves. It relied solely on domestic balance sheet absorption. Analysts argue that this limited its ability to escape stagnation. Now connect both historical cases to modern hints. When gold demand rises during geopolitical stress, when crypto surges as bond yields fall, when digital markets attract trillions in speculative liquidity, some economists argue that these movements may indirectly support U.S. debt dynamics, not because Washington controls crypto, because crypto absorbs the excess, not because gold cancels liabilities, but because gold absorbs fear. And if perception stabilizes, so does the system. Here's the trap. If the mechanism works, the public never sees the cost. If it fails, the correction is sudden and violent. The real question is, are we watching debt being quietly redistributed across digital markets, or simply witnessing the emergence of new financial bubbles? The answer requires looking into Section 2, where we explore who gains, who pays, and how this mechanism evolves if global conditions tighten. Because the moment when the pressure finally flows back into the core system, that's the moment that determines whether the United States achieves a quiet reset or faces the kind of break that history warns about. To understand how a system this large can keep operating, even expanding, under a mountain of obligations that would break any ordinary economy, you have to watch how the mechanism evolves. Analysts suggest that the United States may not be erasing $37 trillion in debt in the literal sense, but instead redistributing the weight across parallel markets, alternative assets, and psychological anchors that change how the burden is perceived. This is where the second phase begins. Not with the debt itself, but with the incentives created around it. Because once a nation convinces the world that its liabilities are simply the price of global stability, it gains the freedom to operate inside a financial space no empire before it ever controlled. Here's what nobody tells you. Debt isn't just a number. It's a political instrument, a strategic asset, And when paired with tools like crypto liquidity and gold repositioning, it becomes something even stranger, a system of shared illusions. Japan's experience in the 1990s showed what happens when an advanced economy absorbs its own losses internally. With shrinking demographics, stagnant wages, and a deflating asset market, Japan's state and central bank became the shock absorbers for the entire system. But without external markets to redirect pressure into, the cycle repeated for decades. Some analysts argue that the U.S. learned a different lesson: widen the system. Create global demand for dollars, global demand for treasuries, and eventually, global demand for digital instruments that exist, directly or indirectly, within the gravitational pull of the American financial architecture. And here's why this matters. It means the U.S. may not need domestic austerity or radical restructuring. It only needs other markets, other assets, other vessels to absorb the turbulence. Consider the late 19th century British Empire. By 1890, Britain faced a credit crisis linked to South American loans. The famed Barings Bank nearly collapsed under the weight of Argentine debt exposures. But Britain avoided catastrophe by leveraging its global footprint. Colonial trade routes, gold reserves in India and South Africa, and imperial influence over global capital flows. It redistributed the shock, not through financial engineering alone, but through the sheer breadth of its empire. Some historians argue that this bought Britain decades of continued dominance. Others claim it merely pushed the inevitable decline further into the 20th century. Either way, the mechanism is clear. Spread the pressure across the widest possible network. Now, watch the modern echo. The U.S. doesn't have a territorial empire in the British sense, but it has something more scalable: a digital empire. Dollar-based payment rails, global reserve currency infrastructure, crypto markets denominated overwhelmingly in USD, commodity markets priced in USD, and analysts suggest that this structure allows the U.S. to spread financial pressure in ways no previous power could. If crypto absorbs speculative liquidity, if gold absorbs fear, if global markets absorb dollar expansion, then U.S. debt becomes harder to measure in traditional terms. Not erased, reframed. When new financial ecosystems emerge, crypto networks, tokenized commodities, decentralized exchanges, they don't just create alternative stores of value. They create new places for global capital to hide from volatility. This means that whenever the U.S. expands its balance sheet, some of the ripple effects travel not only into bonds and equities, but into digital assets and foreign reserves. If this pattern applies, then the U.S. indirectly benefits from every new digital market that captures investor interest. Analysts argue that the more liquidity these markets attract, the more space the U.S. has to maneuver, because the public debate about debt becomes disconnected from the actual consequences of borrowing. But who benefits from this evolving mechanism, and who pays? The beneficiaries appear first: financial institutions, hedge funds, tech-driven liquidity players. They thrive in systems where volatility can be monetized, where alternative assets rise during expansion and crash without dragging down the core economy. They profit because the mechanism creates optionality, multiple escape routes, multiple revenue paths, multiple asset bubbles that can be exploited before they deflate. When crypto surges, capital flows. When gold spikes, capital flows. When the dollar weakens or strengthens, capital flows again. The system becomes a perpetual motion machine of speculative opportunity. Then come the parties who pay. Ordinary wage earners who watch inflation erode purchasing power faster than salaries rise. Savers who see traditional accounts yield less than market turbulence demands. Retirees who depend on fixed income assets while the real value of those payments shifts with every policy adjustment. And citizens who carry the invisible tax created by inflationary cycles, an unavoidable consequence whenever governments expand money supply faster than economic output. Everyone thought they were safe. They weren't. Analysts argue that the mechanism works only because the public doesn't feel it all at once. The pressure spreads across thousands of microshocks. Rising rent here, shrinking 401ks there, energy prices fluctuating with geopolitical tensions, crypto markets swinging violently enough to distract from bond market fractures. Here's the trap. When consequences disperse widely enough, no single group notices the entire cost. And that's what allows the system to continue. Now, we move into the conditional modern operation of this mechanism. No economist claims with certainty that the U.S. is deliberately using crypto and gold as tools to dilute debt. Direct coordination between independent markets and state policy would require evidence no public data supports. But analysts observe patterns. They note correlations. They build scenarios. One scenario indicates that rising crypto valuations during periods of monetary expansion help neutralize inflation expectations by channeling speculative capital outward. Another scenario suggests that gold's persistent demand, especially from foreign central banks, supports the dollar indirectly by anchoring confidence in the broader commodity ecosystem. Still, another scenario argues that digital asset innovation could allow for future debt, instruments that interact with tokenized markets, creating new forms of liquidity without expanding traditional liabilities. Each of these scenarios remains hypothetical, not guaranteed. But they all point to a single idea. The U.S. may be operating inside a financial landscape where debt management is less about repayment and more about diffusion. Now, consider the possible outcomes. If crypto markets stabilize, if gold continues its long-term ascent, and if global confidence in dollar systems remains intact, the U.S. could gradually reduce debt-to-GDP ratios through controlled inflation, economic growth, and widening liquidity channels. This path avoids crisis but requires ongoing belief in the system. If alternative markets grow so large that they begin competing with, or even replacing, traditional financial anchors, the U.S. could strategically restructure parts of its debt while rolling new obligations into digital frameworks. Analysts suggest this could create a hybrid monetary system where debt is partially offset by asset tokenization or digital collateralization. If global confidence weakens, if crypto collapses simultaneously with treasury demand, or if geopolitical stress fractures the system, the diffusion mechanism fails. Pressure flows back into the core instantly. Bond yields spike, the dollar wavers, markets ripple violently. This scenario is the least likely according to analysts, but also the most catastrophic. And that brings us to the closing question. Which path are we on? Some economists argue that we may be watching the early stages of a generational shift, where alternative assets become structural components of global finance rather than speculative outliers. Others believe this system is temporary, a patchwork solution delaying a larger reckoning. But all agree on one point. If the U.S. is using crypto, gold, and liquidity engineering to distribute the weight of $37 trillion in debt, then the real story isn't about erasing liabilities. It's about transforming the nature of risk. Because in a world where perception shapes reality, a nation doesn't need to eliminate its debt to survive. It only needs to convince everyone that the burden can be carried indefinitely. And the moment that belief changes, that's when the entire mechanism reveals what it truly is.